Okay, so we're now live. Okay, so making a start. As I said, we're going to be starting on the non-current asset register. So we're going to take a very quick recap just to make sure we all know what we're dealing with. As the majority of you will be aware of at this point, when we're looking at the sort of questions that were given throughout our studies and in these exams, primarily we're given a singular example. So a company has bought a car or a machine, and then we're really doing a lot of work that relates specifically to that. Now, however, let's flip the coin and let's look at a real life business. It's very unlikely that any company out there is going to own a single asset. Just by the natural, the life cycle of a business, assets will come and go at multiple intervals. So it's really important that we are able to record all those correctly, and then we can keep accurate costs, accurate trail record on depreciation charges, and of course account for any proceeds on disposal. So this is where the non-current asset register comes in. Now, this is a separate entity from items like the books of prime entry. It doesn't form any part of that traditional bookkeeping element, but this is, like I said, this is a register where we're going to keep everything nice and neat, nice and tidy, and we're going to be looking at what we happen when we get new assets, when we depreciate previous ones, and when we dispose of them. So when you're doing this in your advanced bookkeeping exam, you are going to be given those three scenarios. We can never say always, but it is incredibly likely that is what you'll be asked to deal with. So just moving on very quickly, as my screen freezes. So yeah, the details of the register. So like I said, we know roughly what is going to be involved in this register. It's going to be a lot of work that we've done previously. And truth be told, the actual process of filling in a register is relatively straightforward. It's a process of data input, which, in terms of other things that we've done, relatively straightforward. The tricky part comes in these questions, like I said, is you won't just be asked to insert figures. You will be asked to find out what the figures should be. So again, we're going to be looking at capitalizing assets, depreciating assets, inserting disposal figures. That is where the tricky bit comes. The actual process of putting the numbers into a register is really, really quite simple. So if we can sort of master the previous aspects, which we've already looked at, again, depreciation and so on, we can really pick up good marks on this. This generally comes up as task 1 in your advanced bookkeeping exam. So this is the one, if we can get a really good grip on this, we can post, full marks. It gets you a really, really good head start come your full exam. So let's look at the details of the register and the sort of entries that we're expecting to see in there. So description, serial number. Now again, let's apply this to your AAT exam. You will be given product codes. So you won't just be told that a company has bought, let's say, a new oven. The oven will be given a specific product code. And again, this is about accuracy when we're recording that data. We've also got the acquisition date, which again, we talk about acquisition. It's basically the day that we purchased the asset. Again, another important one. And this does tie in with depreciation, as we'll get to momentarily. And then we also talk about the original cost. Now, again, we're going to take a look at what we mean by original cost, because as some of you may be familiar with from your previous studies, there is quite a mixture. It's not just as simple as we paid X amount for a machine. We are going to have to sort of nitpick through different transactions to make sure that the cost that we record is in fact correct. As I just mentioned, we're also going to have depreciation. And again, depending on how the business does it, it is, again, a bit of a top tip for your exam. You may be asked to use more than one method. So when you're looking at this register, you will have sort of different items. So again, you might have sort of kitchenware and then machinery. And those two sort of separate assets may be depreciated differently. So we need to pick up that detail really, really quickly. The net book value. So again, those of you that are familiar with depreciation will understand what we mean when we talk about net book value. This is essentially what we are valuing the asset at after we have taken into consideration depreciation over however many years, generally perhaps around 1 to 3, normally in your exams. We've also got, my PowerPoint lets me carry on, the funding method. Again, relatively straightforward, but it is an important part of the register. So when we talk about funding methods, we're not just looking at a business pays £10,000 for a machine. We need to consider how it was bought. So again, let's just roll off a couple of common examples. Use things like hire purchase, again, paying in cash, leasing. We need to make sure that the method of funding is recorded on the register. Again, just provides us with a bit of clarity when we're looking at the information specifically. And sort of moving on to the end point, we've got the disposal date, which again, very important. Once an asset is no longer in the hands of the company, we need to make sure that it is disposed of and reflected correctly on the register. Now, we're sort of stepping away from the double entry aspect here. Very similar to depreciation. When we're looking at it in this respect, we're not being asked to record any double entry or insert any sort of double entry for the disposal. We're purely looking at the disposal date and the disposal proceeds. And these, again, will be recorded on the register. So if we paint a full picture of the entire life cycle of an asset, we can tie all these in with it. We'll have, again, an appropriate description, the day we bought it and how much we capitalized it for, its original cost. We'll then have, over a period of time, numerous depreciation charges. Linking in with that, we will be able to see the net book value as we charge that depreciation every single year. We'll also be able to see the funding method, and then ultimately we will see when we got rid of the asset, and of course the proceeds that we got for it. So that is it. That is the only information that we will be expected to put into the asset register. Now, as I said, the devil is in the detail here. So when we're looking at areas that you're sort of more specifically likely going to be questioned on, very, very likely you are going to be asked to calculate depreciation in some respect. Incredibly likely that you're going to be asked to record the original cost of a new asset. And again, very, very likely that tied in with depreciation, we're going to have the net book value. The disposals part of this section is, in truth, relatively straightforward. And what I mean by that is, like I said, we're stepping away from the double entry. We'll just be told we've disposed of an asset, the proceeds were this much, and we disposed of it on this date. And then we'll just enter it into the register. So in that respect, disposals, which can be a bit of a bugbear when we look at the double entry, relatively straightforward at this stage, which I'm sure will be a big relief for some people. Okay, so moving on. So we're going to focus on not necessarily filling in the register, but looking at certain aspects. And the big one that I want to sort of focus on tonight is capital expenditure. Again, just because of the time we're working on, I don't want to waste the entire half an hour just showing you guys how to fill in a register, when respectfully, like I said, that's just a case of data input and I don't want to insult anybody's intelligence. We're going to work at these figures and see how do we get the correct figures to put in. So we're going to start with capital expenditure. Now, those of you that have done level 2 previously and have made a start on level 3, you will be very familiar with the terms capital expenditure and revenue expenditure. Now, these two terms do come up again, and this is another application for them. So when we look at non-current assets, we're focusing primarily on the value of an asset and essentially what costs that we can attribute to it. So just to pull up a little quick question for you here. So we've been told, when we're considering the value of an asset, which costs can we attribute to the overall cost of an asset? So we've got 6 options here. We've got delivery costs, we've got maintenance fees, installation costs, annual insurance costs, alteration costs to make this asset usable, and then power to basically run the asset. So before we sort of get into the nitty-gritty detail here, I'm just going to give you guys a minute or two to have a go in the chat. So I want you to have a look at these and basically say which ones you think we are going to capitalize. And essentially, again, that means we are going to include in the cost of the asset when we record it in this book. So like I said, I'm going to give you guys a minute. Just put your answers in the chat if you want to have a go. If not, again, just maybe scribble some notes down. Okay, some people filling it in, that's great. Okay, brilliant, some good answers. I'll give you another 30 seconds, guys. Okay, looking good. So I can see from our answers that we're pretty much on the right track, which is really, really good to see. So again, let's break this down. And we're going to sort of get the cheat sheet up at the end, but it's always interesting to sort of see what people sort of have ascertained from prior knowledge. So I'm just going to get my pen up. Okay, so when we look at delivery costs, we are going to include that. My pen's going to let me draw. Because when we fundamentally break this down, without looking at the specific sections first, a very good rule of thumb, which is a rule I was actually once told when I was doing my level 3 studies, and it sort of stuck with me, is that when we're considering the amount to capitalize, we need to include the costs of the asset and anything and everything that is involved with getting that asset into our warehouse, to us, and working. Anything that falls under that bracket, we capitalize. So delivery costs, as a lot of people have said, that is included. Now maintenance fees is not included, and that is because it is revenue expenditure. So again, I'll pull the answers up in a minute, but just bear with me as we sort of carry on through. Installation costs, again, a lot of people have picked up on it. That is correct. And let's apply that rule again. It is required to get the machine, or the asset, I should say, in working order. So installation costs are included. Oh, excuse me. My pen going off. Fantastic. Annual insurance costs. Now, this is sometimes one that catches a lot of people out because they believe it's a bit more, directly relatable to the asset, which in argument it is. However, in this instance, we are still going to class it as a revenue expenditure because it's a year-on-year cost. So again, okay, number 5, alteration costs to make the asset usable. Now again, this is going to be capitalized. Again, let's just run that trail of thought in our head. We do need to pay this cost to get this asset to us and in workable condition. So the clue in that one is sort of in the description, alterations to get the asset usable. And then the bottom one, power for the asset. Obviously, we can sort of see a pattern emerging here. We aren't going to include that, and that is revenue expenditure. Now, a good question that people sometimes ask is, why do we not include power when we applied, again, the logic we just looked at, things that involve getting the machine to us in working order and up and running? Some people will argue, well, why don't we include power? Because without power, how do we run this machine? It's a very, very good question. However, when we sort of break it down into its sort of simple form, we're looking at long-term costs. Power is a revenue cost, which essentially, we're going to have an amount which runs year on year. So let's now have a look at the items that we exclusively know are going to be involved. And again, there's a couple of important little bits that we're going to look at here. So some of them relatively straightforward. The purchase price of the asset, well, of course, we are going to include that. That one really goes without saying. We've also got alteration costs to make the asset usable, as we've just covered in the previous question. Legal fees associated with purchasing the asset. Now, this one's most common in property, and without playing devil's advocate, you are probably not going to be likely be dealing with property, particularly in your advanced bookkeeping exam. You will be probably, again, working more on machinery, might be something more specific like catering equipment, vehicles and stuff like that. Very, very rare property comes up. On the occasion that it does, and like I said, it says here, any legal fees, we are going to make sure that we do include that in the amount that we're going to capitalize. Non-refundable taxes and duties. Now, this one ties into quite an interesting point. Now, a very common pitfall is when we look at the VAT element of these sort of questions. So without spinning an incredibly long, convoluted story, again, let's break it down into short and sweet summaries. So if a business is VAT registered, the tax element, or the VAT, is not going to be included in this capitalization amount, because obviously we're going to reclaim that as input VAT against our output VAT, and so on and so forth. However, and this is where the clue comes in the question, we need to read them really, really carefully. If we're told that a business is not registered for VAT, that element of that needs to be capitalized. And this is a really important part. So it's such a common pitfall and a really, really easy mistake to make. And it fundamentally comes down to reading that question and making sure that we're absolutely on point and we know what we've been told specifically. So just to reinforce that, if a business is VAT registered, we do not capitalize the VAT element. If a business is not registered for VAT, we will include that in our capital cost. Site preparation costs, again, this one does come up quite often and does trip people up. But again, let's apply that logic. You know, we need to make sure the site's in suitable use for this new asset to arrive. So again, it's part of that process of arriving to us and being put to use. We've also got delivery costs, a relatively straightforward one, quite straightforward to remember. Installation costs, again, a relatively common one, but don't get yourself tripped up. Testing costs. Now this, again, this one isn't particularly common, but just so you are aware, it can fall under capital expenditure. So when we talk about testing costs, we're essentially meaning any sort of costs incurred. Say we've got a machine, for example, and there's a charge we are going to incur to make sure that this machine is actually functioning properly. So that is what we call testing costs. And again, let's just apply a nice little rule to this. So any costs, as I've just previously said when we looked at the power element, any costs that only relate to a single accounting period, we're going to treat them as revenue expenditure. So let's have a look. Repairs, maintenance, cleaning, insurance, and power, fuel, that sort of thing. So in truth, an area a lot of people trip up on is maintenance, because they sort of consider it to be, sort of like not a year-on-year cost, more like a job cost. You know, we can't necessarily say when something's going to need to be repaired, how often the maintenance is. But again, let's apply a rule of thumb here. We look at repairs, we look at maintenance. They fall under revenue expenditure. So that's what about labour costs for an alteration? So alterations, that's a very good question. Now again, you could add that on. It depends really again on what the alteration is for. If we're talking about an alteration in terms of it's to, you can, you know, attribute it to repairs, or it's just some, you know, these alterations are taken part due to general maintenance. In that instance, yes, it's more like revenue expenditure. If this is an alteration to enhance, you know, the productivity and the overall value of the machine, then at that point we can class it as capital expenditure. You know, without sounding like I'm sitting on the fence either side there. But again, Sarah, the sort of labour costs not likely to come up in your exam, but again, it's quite situational, and that's where again the devil will be in the details. It will sort of tell you what sort of work it is. They might say that there's been an alteration as part of routine repairs, as part of routine maintenance, and so on and so forth. And the final is, that's what about a renovation alteration? So again, we can sort of apply the same logic when we talk about renovation. You know, we can apply that to primarily buildings would be your first instance, but again, you know, we can do it to machines. And again, it's whether or not we are adding a distinguishable value to the asset. If these are renovations because the building or the machine is in disrepair or it isn't functioning properly and it's just part of a maintenance program, again, we're looking at revenue expenditure. So again, the clue will be in your question, but they are good questions. It's you know, it's definitely worth knowing. So, you know, thank you, for bringing that up. So to sort of wrap up with a register checklist. Now, like I said, I'm not sort of going to run through how to fill in the register because, respectfully, it's a process in data entry, and I'd imagine you know, you guys will be quite familiar with that. So again, I wanted to really focus on just the overarching capitalization section. We've covered depreciation in session 1, so again, we're not going to run over that because, truth be told, to squeeze all that into 30 minutes, I'm going to sort of go in at the speed of light, and it's not really efficient and really effective for you guys. So just to end our advanced bookkeeping section, we can really break this down into essentially a bit of a checklist. It's a simple process of administration, and if we follow these steps, we'll start to fill in slots of that register. So acquisition of new assets. So again, I can never say always, but I'm incredibly confident you will get a new acquisition if you're given a non-current asset register in your exam. So what do we need to focus on? The method of funding is a big one. Again, hire purchase, leasing, paid for in cash. It is so simple. And this is one of those things where these are quite easy marks for us in what is traditionally quite a tricky exam, because the question will tell us this. We're simply just reading through the information. We won't be asked to decipher this from a load of different information. You will be outright told what the method of funding is, and then all we're going to do is move down to the register, and on your AAT exam, it's just a multiple choice box. So you'll just click on the arrow and then select the correct one, and you picked up easy marks there. We've also got the date of acquisition. Now again, this is another chance to pick up easy marks, because again, we're not having to pick this information out. This is going to be provided to us. We'll be told on the 1st of December, whatever year it was purchased. Again, make sure we put it in the correct format, easy marks. Capitalization amount. Now, of course, this is where the register in its own sense becomes a little bit trickier. So as we've just covered those figures there, now it's, again, I can never say never, but I'm never say always, excuse me, but I'm incredibly confident that you won't just be given an asset and this is what it costs and there's no other figures that you need to consider. If that happens in your exam, you are incredibly lucky. You will be given the value of an asset that's been purchased and, let's say, 2 to 3 additional fees, and you'll have to select the right ones. So again, you may have a delivery fee, an insurance fee, an installation fee. It's your job then to pick through and make sure you add on the correct costs. So that's the key points that when we're looking at the acquisition of a new asset. And then moving on to depreciation. Now again, we haven't gone into depreciation in this session because we have covered it in a previous one, but again, it is going to come up. So let's just look at what we need to make sure we're covering. So depreciation method or methods, and that's the key to this part. Very common mistake to make. It is incredibly likely, again, that you will be given multiple assets, some which are already on the book, an acquisition of new ones. They may be depreciated differently. Motor vehicles may be depreciated differently than office machinery, and so on and so forth. It's a very easy mistake to make when, quite simply, we pick a depreciation method and then we just use it for every single thing on the register. It's such an easy mistake to make. We've also got depreciation policy. Now again, in terms of how these questions work, those of you that might be relatively familiar with these AAT exams, you're essentially given 2 scenarios. You may be told that the business has a policy of charging a full year's depreciation in the year of acquisition and then none in disposal. Or you may be told that the company charges depreciation on a pro rata basis. So again, we're working into the finer points of depreciation here, but you are definitely going to get a bit of a mixture of the 2 of them. So be very careful. And again, just to sort of mention, if we're charging a full year's worth of depreciation in the first year, that's fine. But again, pay close attention to the second part, and none in the year of disposal. So then when we're scrapping that and we move on to the disposal section, we need to make sure that we leave that depreciation section as a 0. So again, very easy mistake to make. New assets and carrying amounts. So this is where, again, we're not going outside what we've already covered, but we're going to be sort of looking at information from different angles. Again, we will have new assets. So when we depreciate them, we're of course going to go off the capitalization amount. However, you will get a register that is already running. There will already be sections of this that are happening, already sections which will have been sort of pre-filled in for you. So when we're charging depreciation on them, it's really important that we charge off the carrying amount. Now, these, again, the carrying amount will be visible for you. If an asset has been owned for a couple of years before we've now moved in and we're sort of filling in the rest of it, it will be visible to you. But again, it's a very easy mistake to make when people don't sort of catch it out, and then they'll just immediately go straight to the original cost. So for pre-used assets, you'll see that we bought it a couple of years ago. There's a couple of years depreciation charge already on there. So let's make sure that when we depreciate again, we're working off that carrying amount. And then for the final section, the disposal. Now, as I sort of said, this bit is pretty nice compared to the rest of the register, in truth. So the information that we really just need to make sure we're covering is the disposals date and the proceeds. Now that's it. Now again, we're not concerned about the double entry at this point. We're not getting involved in any of that. We're going to debit this and credit that. We're purely just registering A, how much we received for this asset, and B, when we actually sold it. And that is it. That is the sort of checklist that you will be wanting to work through in your mind as you're going through these. So again, just to give you guys a bit of context, where your primary time is going to be spent, again, it's going to be on the capitalization amount. Is going to be a very big part of your exam, making sure you get the right amount. And of course, your depreciation is also going to be the next large part. Like I said, the disposals, relatively straightforward. Method of funding, you'll be told it. The date of acquisition, the date of disposal, you'll be told them. So we don't need to get ourselves concerned about them. The primary things we need to focus on, again, let's make sure we nail this depreciation and we nail the capitalization amount, and the rest will fall into place quite nicely. So Jenna has asked, would you capitalize a number plate for a new van? That is a very good question, actually. So if we're talking about a brand new van and we're sort of purchased a private number plate, it's whether or not we can add a definable value, or we can add a value that simply relates to the asset. So is it enhancing the value of the asset? I would argue so. And again, if it's in the first instance, I think so. And yes, as a van needs a number plate. When you buy a new car, it should come with a number plate unless you want a private one. Yeah, it's a very good point. It's quite an interesting one, because you can form quite a reasonable argument for both sides. Again, on the very slim chance that would appear, you would capitalize it. But again, truth be told, I wouldn't get particularly worried about that. We can never say for sure what's going to be in these exams, but based off previous sorts of, previous experience, like I said, they tend to lean more towards machines with this register, and they're big fans of office equipment as well. No, you don't need to apologise, Jen. That's absolutely fine. Okay, guys. So we're just going to have our sort of intermission period now. So we've sort of just passed on from the advanced bookkeeping section, and we're now going to move into the final accounts. So same as last week, if you just wanted to come for the advanced bookkeeping, please, you don't have to stay around if you don't want to, because the FAPI doesn't sort of relate to you. You are more than welcome to stay though, just for your own future reference. These sessions are recorded and they will be sent out afterwards. So if you do wish to stay, and then I have been letting people in as we're going through. So I don't believe I've got anybody else in the waiting room, which is absolutely fantastic. And I don't. Okay, that's absolutely fine then. So again, I'm going to sort of jump straight in, because again, I'm semi-conscious of the time. I don't want to overrun too much. But yeah, so advanced bookkeepers, please feel free to stay, or of course, if you want to sort of just step out at your own, at your own leisure, that's absolutely fine. Yeah, so we're going to move on to final accounts now. And as we said at the start of the session, we're going to be looking at sole trader accounts. So what we're going to be doing in this section now is, again, I'm not going to insult your intelligence by saying this is how you fill in a statement of profit and loss. We're going to have a look at them, and we're going to break them down into the components. And then we're going to look at when we have our two primary statements, which is obviously a statement of profit and loss, statement of financial position. And then we're just going to see essentially where we pick the information out from when we're filling these in. So let's move on. So very, very quickly, let's just widen the scope a little bit when we look at final accounts. So when we talk about sort of different entities, and again, entity is the key word here, one which you'll be, I'm sure, relatively familiar with at this point, particularly with final accounts. So we've got sole traders, which of course is what we're going to be covering now. We've also got partnerships. Now, within final accounts prep, sole traders and partnerships are bread and butter. It is the primary content, very heavily covered, and something you will definitely be examined on. And Catherine has just asked the question, do we look at limited companies in this instance? Now, Again, the short answer, excuse me, is no. When we move on to level 4, we do have obviously the unit financial statements of limited companies on the current syllabus. But no, we don't look at anything in like particular detail. We may, I think if you go through your reading materials, there may be like a section of a chapter that just shows you the difference, but it's not something that you're going to be examined on. We've also got to be aware of NPOs, or non-profit organisations. So again, in terms of their involvement in this, you're looking at more multiple choice questions, just a bit of general knowledge, and the same can be said for sort of limited companies. Where the nitty gritty, particularly with limited companies, only really comes in at level 4. And I think Sarah just mentioned it there in the chat as well. Okay, so again, let's zoom back in now. We're focusing purely on sole trader accounts in this instance. So let's just have a quick look before we get into it about what is a sole trader. We talk about entities. What is the entity that we define as a sole trader? So we talk about it in its simple context. It's a business. It's managed and owned by a single person, one individual. There's no legal distinction between the business and its owner. There is unlimited liability faced. No requirement to file annual accounts. Records for tax returns are required, and then the owner is taxed personally on the profits of the business. So in terms of what's good, what's bad about sole traders, we can look at this. There's positives, there's negatives. So again, I'm going to give you guys a couple of minutes. If you can think of maybe a couple of positives, maybe a couple of negatives, and there's be creative with it. There may not be necessarily a wrong answer if you can provide legitimate evidence. It's just a good opportunity now for you guys just to sort of show me again what we know up to this point. So again, I'm going to give you a minute. Have a go in the chat. Just try and think of a positive of running a company as a sole tradership, and maybe what maybe a downside as well. Okay, brilliant. I can see some answers coming in. That's fantastic. So Naeem has made a couple of very good points about decision making. Amel, unlimited liability, big negative, very good point. Richard, positive, you have complete ownership. Fantastic, great answer. No final accounts format pressure, that's correct, Nathaniel. Sarah, full control over business decisions, positive. No cover for holidays, no cover for sick leave, very good point. Okay, brilliant. Right, we've got some really good answers there. So just to pull a couple up now, if what you've said hasn't come up on this list, please don't worry. This list is not an exhaustive one. There's some really good answers we've just had there. So let's look at some pros and some cons. Claudine, negative, longer hours, liable for any debts, correct. I think it would be positive, but on the other hand, negative as well. Yeah, this is it. It's arguably quite subjective in that respect. You could argue good or bad for certain things. Let's just look at a few, for example. As some people have already touched on, we have total control over every single business decision. You're the sole trader, it's your business, you decide where it goes and the direction that you want to go in. And again, as some people have touched on, we have all the profits that are going direct to the owner, obviously in brackets after tax. And again, pros, simplified accounting, as Nathaniel said. We're not being sort of restricted more by formats. You will see, especially when you get onto level 4 and we're looking at financial statements and limited companies, the international accounting standards are very, very strict. The sole traders have not unlimited sort of anonymity from that, but we have a little bit more flexibility. And then again, let's flip it. Okay, sounds good. What are the negatives? Potential lack of support. Now, some people have touched on this in different ways. Naeem said, lack of support. Some people have made good points about, if you're away, you've got no cover, longer hours. And again, when we talk about a business, it's a collaborative effort. If you're working as an individual, it can be very hard to sort of build a network around you to make that business successful. You might not necessarily be able to rely on another director. You can sort of take business steps and go do some sort of networking, but you are fundamentally supporting the framework of that business in your own two hands. Find it difficult to get capital injection? That's a very good point. I mean, if you are a sole trader, Sarah, obviously you would be the only individual obviously putting capital into the business, unless you were sort of looking at expanding and going into a partnership or moving into becoming like a limited company. And a big con, unlimited liability. Now this one, again, the clue was in, we've looked at the definition. Now what of course we mean by unlimited liability is limited companies are sort of set up in a framework where if the company does ever face financial difficulty or fall into trouble, the company or you as an individual will only be liable for your investment in said company. That does not apply to sole traders. If a sole trader goes under, their personal property, their personal possessions will be liable, not just what is directly attributable to the business. And this is a very, very big concern for a lot of sole traders. And then of course, potentially no guaranteed wage. And again, we've sort of looked at this, you know, if you are unwell, if you decide to go on a holiday for 3 or 4 weeks, that is 3 or 4 weeks the business isn't operating because there's nobody else to work for it. So in those instances, yes, we're facing a lot of difficulty. So there's pros and cons to each side. Now, your role in, again, let's sort of work this to the exam. Your role isn't to sort of describe why one is particularly better than the other. So again, if we look at partnerships, which we are going to next week, we'll find that there's pros and cons to that as well. You won't be asked to formulate an argument and discuss why is this one better than that one. Not a case of that. We're looking at more, do you understand the potential positives and the potential repercussions of a sole tradership, of a partnership, of a limited company? Like I said, we won't be pitting them, we won't be sort of pitting them against each other and sort of scrapping. And Amela's made a good point. You can employ people while you're being a sole trader. Again, applying this to your exams for the purpose of your AAT exams, a sole trader will be a sole entity in this case. Okay, so let's move on to the accounts now. So starting off, statement of profit and loss. Again, one of the two statements that we're going to be looking at. Now, again, we've got a filled in pro forma one here because, again, respectfully, I know it's okay, very similar to the asset register. It's almost a process of just data inputting. We're going to look at where we can pull the figures out from and identify them shortly. So let's just have a quick breakdown of the different elements here. So straightforward at the top, sales, and then we've got our cost of sales. So the formula, which you guys will probably be aware of by now, is our opening inventory plus our purchases less our closing inventory. And then of course, that gives us our gross profit. Okay, now one thing it is worth mentioning, and that it sometimes catches people out, is we give ourselves gross profit, we work that out, and then we have this little tidbit here, gross income, or sundry income, excuse me. So something like this, quite likely to pop up, and a really, really popular one that the AAT like to use is recycling rebates. I'm going to write as neat as I can. So when we look at sundry income, rebates falls into that category. So this is essentially money that has been returned or money that's come into the business outside the traditional scope of selling a product. So again, a recycling rebate, an energy efficiency rebate, anything that falls sort of under that bracket gets its separate section. Now, again, when you're doing this in your exam, you probably won't be given sundry income. You'll be told it's something specific. So it's just something to be aware of, something to keep an eye out for. Because again, very likely one will come up. And I can never say always, but they love rebates. So do keep that in mind. So, okay, we've been working out money coming in. We've worked out our cost of sales. We've figured out our gross profit. So let's break it down now and look at the expenses. So again, I'm not going to run through all these individually. You guys will be, relatively familiar with these at this point, I'm sure. So all we will do is we're going to total all these figures up, and that'll give us a nice rounded figure at the bottom, which is £55,000. And then we have our net profit for the year. So again, just to sort of relate this to some familiar terminology we've seen up until this point, of course, we're working on gross and net. So let's make sure we always distinguish between the two. And Magda's made a very good point about the cost of sales. We've got quite a simple formula at the top here. Please also consider carriage inwards. That will form part of the cost of sales. It is provided to you. And then Sarah, rental income, yeah, that would fall under sundry income because, again, it's not forming part of our traditional sales. So that's our statement of profit and loss. Again, I'm going to show both statements and then we're going to do a bit of an extraction activity from a trial balance. So let's move on to the statement of financial position. So again, there'll be some terminology that you're already familiar with, maybe perhaps in a slightly different format. So let's have a rundown from the top again. So non-current. So this is our non-current assets, which is our figure of £50,000. And then we're looking at current assets. We've been told we've got inventory, receivables, cash. We've also been told we've got current liabilities, which is payables or trade payables of £53,000. So we're seeing, if we look at this, there seems to be figures separated a little bit more. So let's break this down. We've got a figure of net current assets, 23,000. So the clue here is in the name, current assets. So we've been told at the top, we've got a non-current figure, and then we've got two current figures here, current assets, current liabilities. So the net current assets is only going to consider those two parts. So again, you should be able to spot it already. That 23,000 is simply coming from £35,000 less 12,000. Again, relatively straightforward. So we can now see where those figures tie in. We're now going to bring in the overarching style. We've got non-current liabilities to consider now. In this instance, we've just been given a bank loan of £10,000. And then we're told about net assets. So again, you can probably see where these figures are starting to all tie in together. So 63,000, and we've got that from our non-current asset figure of £50,000 plus our net current assets figure of £23,000 less our £10,000 of non-current liabilities. And now what you will notice for this final part here is when we look at proprietor's interest. So capital, profit, less drawings. Now, a good rule of thumb is that when you are filling these in, your net assets figure should always be the same as your end figure. When we take into consideration capital, profit, and we remove any drawings, those two figures should match each other. If they don't match, something's gone awry somewhere. Something's been miscalculated, something's not been entered in its appropriate section. So again, that's how we sort of fill in the financial position. Relatively simple. It's an exercise in administration. We're doing some simple mathematics. Quite similar in some respects to the non-current asset register in the sense that we need to make sure that we are getting the right information to fill in these statements. So again, I'm not going to sort of ask you guys to fill one in because it'll be bedlam to try and keep on top of that in the chat, to be truthful with you. However, we're going to break this down into the steps you should take, and then again we're just going to wrap up with a little activity where we're going to pluck figures from the trial balance. Okay, so steps to success. It's very lovely called. So step one. So simply for all the items in the trial balance, we need to decide and note down whether this item should be in the statement of profit and loss or the statement of financial position. So again, we're going to have a look at that in a minute. And then those of you that are familiar with the analogy dead click or maybe pearls, but I'll be honest, I much prefer dead click. You'll see how we can use that to basically give us a bit of a mind map as to where we're going to put these certain transactions. Step two, a skeleton pro forma will be given. You will need to fill in the detail of the heading. So again, you won't be asked to sort of draw this table out from scratch. You'll have a skeleton in place. You will fill it in as appropriate, very similar to the non-current asset register in that respect. And then we're going to insert the figures from the trial balance into their relevant places and then add the statements up. That is it. That is the sections and the breakdown of how we fill one of these in. So again, when we look at it in that way, it sounds quite simple. The clue, or the trick, as I should say, is breaking a trial balance down. So we're gonna, just to see how I'm gonna do this actually. I'll run through one at a time, just so people aren't sort of chasing off in the chat going through them. You can sort of make the notes yourself, or we can go through it together. So this, obviously, you can see here we've got an extract of a trial balance, as we would be asked to do in the actual live question. We need to now split this into the correct statements. What is going in the statement of profit and loss? What is going in the statement of financial position? So what I'm going to do is, again, I'm just going to pause for a minute. I'm going to let you guys write them down. You don't have to do them all in that 60 seconds, so please don't streamline through it and panic. And then we're just going to run down them. And again, I'm going to encourage you, if you think it's P&L, put it in the chat. You think it's statement of financial position. And like I said, we're going to run through these one at a time. We'll just have a bit of a talk about why it ends up in said account. And again, I'm going to relay it to dead click quite a lot, because I think it's a very handy way of sort of getting around it in truth. So yeah, I'm going to give you about 60 seconds, guys. Have a look, and then we're going to break this down one by one. Okay, good stuff. So I think we'll make a start now. Like I said, please don't panic if you haven't finished it. I'm not expecting you to get every single one of these in 60 seconds. That would be incredibly unreasonable of me. But like I said, we're going to run through these individually, and then let's see if we can figure out why these things belong in certain statements. So for the first one, we've got accumulated depreciation, fixtures and fittings. So what I'd like you to do is, if you want to be involved in the chat, you can simply put in P&L for profit and loss, or SFP, SOFP, the statement of financial position. So I can see Nelly has gone, oh, Nelly's got an awful lot of answers already. We've got Sarah, statement of financial position, Richard, statement of financial position. So yeah, I think we can see there's a pattern emerging already. Claudine, Alison, brilliant. Adelina, fantastic. So yeah, statement of financial position. And if we look at why now, I'm not going to ask why for every single one, because again, I don't want to keep you guys here until midnight. If we look at it in this instance now, accumulated depreciation, if we sort of use that analogy dead click, obviously we're working on the credit side here. It's not a debtor, it's not income, it's not drawings, it's a liability. So as we know, liabilities belong on the statement of financial position. Now I'm going to try my very, very best to write neat here, because it's a very small space. So I'm going to have to get my pen very, very fine. Please do excuse my very poor writing in these small sections. Okay, brilliant. So, and I've just filled in both there, because I'm not going to ask you to do the same again. It doesn't matter what the accumulated depreciation is for. Of course, it is still accumulated depreciation, be it for fixtures and fittings, vehicles, buildings, whatever it is, it's still going to be accumulated depreciation. It's still going to be a liability. So allowance for doubtful debts. What do we think about this one? Are we thinking statement of profit and loss, statement of financial position? Okay, so we've got Magda thinks statement of profit and loss. A couple of statement of financial positions in there as well. Okay, Sylvia, Sophie, statement of financial position. Okay, brilliant. So Sarah's hit the nail on the head there. So we're splitting this, and this is a very common mistake that people make. When we work on irrecoverable debts and allowances and stuff like that, we have two accounts. We have the allowance and the adjustment. The allowance will always go on the statement of financial position. whereas the adjustment will go on the profit and loss. Now, a good way of remembering is, again, just use dead click. Think of that analogy. We know it's on the credit side. We've already been told that. So what is it? It's not a debtor. It's not drawings. It's not income. It has to be a liability. Liabilities go on the statement of financial position. If you flip it and look at adjustments, we're really looking at increasing an expense for the year, and of course, sort of increasing our income if we're bringing that amount down. So the allowance always belongs on the statement of financial position. Okay, so we've also got the bank balance. Now, again, I think this one should be relatively straightforward. So we've got bank balance. Okay, don't worry, Sylvia, it's fine. So yeah, statement of financial position for the bank. Now, it's a very good point here. It is going to go on the statement of financial position. Nellie's just said it's an asset. However, let's just have a think about this. It's on the credit side. So is it an asset if it's on the credit side, or a liability? There you go. So it doesn't matter where it is. If it's on the credit side, it means that it's an overdrawn balance. Or an overdraft, I should say. So the process is still the same. Still goes on the statement of financial position, but of course we'll list it as a liability as opposed to an asset. Now, capital, I'm not going to ask you to fill this one in. It's don't worry, Sylvia, it's absolutely fine. I'm not going to ask you to do capital because, again, if we're using dead click, it's relatively straightforward. It's already told to us. Okay, so we've got payables. So this may be called trade payables, to put it in another bit more context. And again, I can see people filling it in from the get-go. Statement of financial position, that's fine because let's use dead click again. It's a debtor. That's not a debtor, excuse me. It's a liability. I think it's getting late on a Monday. Okay, so we've got payables, and let's flip it now. Let's go straight onto receivables. We're getting some steam up here, which is great. Statement of financial position, yeah, it's an asset. We're going to use dead click. It's an asset, fantastic. So a lot going in the statement of financial position at the moment, very surprising. Okay, discounts allowed. What do we think of discounts allowed? Okay, I've got some P&Ls in there, statement of profit and loss, exactly that. Statement of profit and loss, expenses, fantastic. So as Sarah's just hit the nail on the head there, oh, excuse me, it's going to be an expense. And then discounts received. Now, again, I think we can just use the process of elimination here, can't we? Let's apply dead click again. We're looking at the credit side. It's not capital. It's not a creditor. Is it liability? No, it's income. So it's in the statement of profit and loss. So we consider it another form of income, just as we consider discounts allowed an expense. Now, drawings, again, I'm not going to ask you to fill this one in because, again, if we use dead click or we've seen these statements, quite self-explanatory. Statement of financial position. Okay, we've now got electricity. So what do we think of electricity? Statement of profit and loss, fantastic. Again, we know why. It's an expense. So fixtures and fittings cost. What do we think of fixtures and fittings cost? I can see again people getting on it very quickly. Statement of financial position because it's a non-current asset. Again, let's relate it to dead click. It falls under an asset. Assets belong in the statement of financial position. Fantastic. Now, insurance and miscellaneous expenses. Again, I can see you guys are steamrolling in the chat now, which is fantastic. Statement of profit and loss for each one. Again, related to dead click. Expenses. Expenses belong on the P&L. Motor vehicles cost. And we've got Catherine Sorthy, statement of financial position. Yep, fantastic. I think we're really getting the gist of it here, which is brilliant. It's an asset. We know where assets go now. Motor expenses. Now, again, I'm not going to ask you to fill this one in because the clue's in the name. Expenses. Expenses go in the profit and loss. What about opening inventory? Profit and loss, statement of profit and loss, statement of financial position. Okay, Sarah's caught it, fantastic. So Madalena, you've made a great point. Statement of profit and loss and statement of financial position. You're on the right track, but you're just looking at the wrong side of the inventory. So just bear with us and we will come to that. As Sarah said, as we've just seen in the previous statement, this is forming part of our cost of sales. The opening inventory belongs in the P&L. And Madalena, again, if you just keep that in the back of your mind, we're going to get to that one momentarily. Purchases, what do we think of purchases? Quite a lot of purchases as well, apparently. Yep, profit and loss, purchases, we can also sort of regard it as expenses, goes on the P&L. Rent, again, there's PLs flying around everywhere, fantastic. And sales, PL. I think an outsider reading this chart would be very confused, wouldn't they? Fantastic. So now telephone cost, again, I'm going to save the question. Now, what about VAT? We've got VAT here, a bit of an interesting one. How do we deal with this one? Sofa, according to Catherine. Brilliant. Yeah, so we've got it straight away. So we're working in the statement of financial position in this instance, because again, we apply the logic of dead click. So on the credit side, it isn't going to be a creditor. It's not capital. It's not income. It has to be a liability. Now, what about wages? Where would wages fall in all this? Profit and loss, expenses, fantastic. Okay, so let's backtrack, Madalena. We've now got closing inventory. And if we look at our double entry or the debit and credit sections, we have two. So why have we got two? Where is this going to end up? What statements are we going to be using here? Okay, yeah, I'm seeing here we're on both. There you go, Sarah's got it. Well, I think everybody's got it, actually, fantastic. So yeah, now closing inventory will end up on both financial statements. We know that it forms part of the cost of sales, but again, let's apply a wider context here. We also know that we own it. It's our inventory, it's an asset. So it is going to be both. Now, how do I write both very neatly in here? That's not too bad. Okay, I do apologize for the handwriting. It's a very small screen and a very small pen, so it always makes it a bit interesting. Okay, well, we're getting to the end now. So we've got accruals and prepayments. What do we think? People are not as quick to draw on this one. There we go. Yep, we've got that logic. So correct for both of these. Statement of financial position for both of them. And then we've got three left. We've got bad debt expenses, P&L. Again, people straight on it. Fantastic work. And then we've got depreciation charge for fixtures and fittings, motor vehicles. Fantastic. P&L for both. I'm seeing lots of P&Ls, which is great. So it looks like you guys have already got it. Just to sort of reinforce it in case anybody hasn't, we've got accumulated depreciation, we've got depreciation. So why is one ending up in one statement? Why is the other ending up somewhere else? So just to sort of bring it back down to quite an accessible level, as we know from our previous sort of sessions, accumulated depreciation, as the name suggests, is where our overall depreciation charge over an extended period of time ends up. So we look at that as a liability, goes on the statement of financial position. The charge for each year specifically, that is recorded on the P&L. Now, again, it's not taken out of our money, but it is an accounting adjustment. And we use that to, like I said, just make sure it's reflected. So the yearly charge always goes in the P&L. The accumulated amounts over an extended period of time, they will go in the statement of financial position. Okay, well, that was really, really good work. Thanks to everybody that got involved in the chat. For also anybody that hasn't, I hope you've had a good crack at the answers. And you know, it has provided useful. So I'm just conscious of the time, having to wrap things up now. Just to bring in the schedule again, we're sticking with this format now. You know, we've been in touch with people, getting the feedback. They're much happier with it. So next week we've got everybody's favourite on Advanced Bookkeeping, bar none. We will be looking at accruals, and then for partnerships, we're going to be looking. We're going to be looking at partnership admission, specifically with goodwill. So very exciting. Now, hopefully Ian Wild will be taking the session next week. Unfortunately, he's still not very well. So that's why I'm here again. Like I said, we're supposed to be doing alternating weeks. He's just not 100% at the moment. Yeah, he will hopefully be back. But if not, the session will still be going ahead regardless, be it from obviously myself. It may potentially be another tutor, because again, I'm keen to get I'm keen to get other tutors to come in and give you guys some input as well, because I think it would really benefit you guys to hear the discussions about other tutors. So of course, so the times for next Monday will be the same. Nelly, I didn't get last week's recording. Can you please send it to me? No problem. Nelly, if you can just hang on in the chat for a second, Nelly. I'll send my email over to you, and then I'll look at getting that recording sent to you. So okay, we're going to wrap it up there, guys. So thank you for your time this evening. Apologies that we've overrun a little bit. So yeah, we're going to be back next Monday, same time. I hope you guys have enjoyed it. And again, enjoy the rest of your weeks, and see you soon.